we're long-term investors who are looking to invest the trust in undervalued stocks, which we believe have the potential to deliver attractive levels of return in the future. As you know, there are some very significant economic headwinds at the current time. Many investors are fearful that we are on the verge of going into a recession. That's not only in the UK, but also in Europe and the US. And on the back of that, sentiment in the stock market has become poor, particularly in certain areas, and certain share prices have fallen very significantly. We never forget that when you buy a share, you're buying into a very long-term stream of cash flows. And actually, what happens in the next 12, 24 months doesn't significantly alter the value of a share to its shareholders, provided you believe that the profit generating capability of the company is not fundamentally impaired. And on that basis, we try to use the current volatility that we're seeing as an opportunity to buy into fundamentally sound businesses, which have been where the share prices have been very beaten down on short-term concerns. So areas that we're focusing on today would be areas such as energy, some of the financials, so banks, mining, and a number of the consumer cyclicals, so retailers and companies in the support services sector. Year to date, it's been a curate's egg, shall we say. So the trust has, in share price terms, is delivered a small positive return in a UK market which has delivered a relatively small negative return, which is, given the deterioration in the economic backdrop that we've seen, particularly since obviously the war in Ukraine started in February, we don't think it is a bad result. And obviously that stands up pretty well when compared to a number of other stock markets in the world, which have fared much worse than that. Amongst the individual stocks in the portfolio, some have fared well. So for understandable reasons, perhaps, energy stocks have done well, obviously on the back of rising oil and gas prices. Other stocks that have done well include the banks. The banks' profitability has been suppressed for a long time by the ultra low level of interest rates that we've seen over a number of years. And obviously, as interest rates have started to rise, that has reduced some of the margin pressure that the banks have been seeing. So they've been seeing their profit forecasts or profit expectations upgraded over the last few months, and that's resulted in share price performance. Strong share price performance. On the other side of the coin, those companies which you could say at the sharp end of an economic downturn, so those companies most exposed to the consumer and perhaps the cost of living crisis, have fared the worst. So some of the retailers, Marks and Spencer, for example, has seen its share price fall quite significantly this year in anticipation of downgrades to profit forecasts to come further down the line. Other companies like ITV and Royal Mail have also found the going difficult. But when you add all that together, you get a portfolio which is there or thereabouts in absolute terms in the year to date. Performances we took on the trust in the beginning of November 2020 continues to be very good. It's a function of our investment style that the performance will be lumpy. You get some quite dramatic periods of outperformance, which is what you saw at the end of 2020 and actually into 2021. You'll get periods of pretty significant underperformance as well. We saw that going into coronavirus in 2020. We weren't actually managing the trust at the time. And then you'll get periods of where the performance is there or thereabouts. And that's been very much the case year to date. going right back to the beginning, I said that we are long-term investors. So our holding period for stocks is, it can be a number of years, 5 years plus. So you shouldn't expect to see in any 6-month period, that dramatic change to the underlying names in the portfolio, and that's very much been the case in the last few months. So very little change in the stocks in the portfolio year to date. What has changed is that we've reintroduced a level of gearing into the portfolio. If you go back to January, beginning of the year, prior to Ukraine, we actually reduced the gearing. We took the gearing out of the portfolio on a view that we felt that inflationary pressures were already building pre-Ukraine, and that could lead central bankers to have to put up interest rates perhaps more aggressively than people were expecting. And yet share prices generally hadn't responded to that. So we felt that there was a degree of complacency in the market. And so we felt it was right to take the gearing off in January. Now, share prices have obviously generally, a good number of share prices have responded to increasingly tight monetary conditions, and obviously the dislocation that's been caused by the war in Ukraine. And share prices, we think, now much more adequately reflect some of the risks that are evidently out there. And so in the summer of this year, we actually reintroduced, we put the gearing back into the portfolio. Today it's around 5 or 6% of the portfolio. So not massive, but nevertheless potentially significant. It's somewhat of a cliche to say it, but we genuinely believe that UK assets are on sale at the moment. As I said previously, the stocks that have been hit hardest over the last 6 to 9 months have been those companies which are at the sharp end of a consumer-driven downturn. And those are companies such as retailers, some of the media companies, telecoms companies will be good examples of that. Two companies where we think the opportunities are significant are ITV and Vodafone. ITV is obviously a UK-focused business. There are two parts to ITV. There's the studios business, which makes content for both ITV itself, but also for other service providers. And then there's the broadcast business, which we're all more familiar with. That's the advertiser funded part of the business. ITV's profits are obviously sensitive to levels of advertising, and as it's become apparent that the economic outlook is becoming more difficult, so expectations for advertiser profits have been declining in recent months. But again, circling back to what I was saying earlier, we will remind investors that the value of a share to its shareholders is not set by the expectation for next year's profits or even the year after. It's set by the long-term profit generating capability of the business. ITV in last year's 65p share price last year made 15p of earnings. So it's on historic P of less than 5 times. In the long run, there are reasons to believe that ITV made excess profits last year, but in the long run, we think the company should be capable of making 10 to 12p of earnings, which would place the company on a what we would call a normalized PE of 6 to 7 times, and obviously from those earnings, we continue to expect it to pay a very generous dividend. Second stock I'd highlight would be Vodafone. Vodafone is a stable but low growth mobile telecoms company, as you know. A relatively small portion of its profits are derived from the UK. The large majority of its profits are derived from continental Europe and from Asia. The company is valued, stands on a cash PE of less than 8 times, and it offers a sustainable dividend yield this year of around 7%. So its profits are not denominated in sterling. Its share price is denominated in sterling. The share price has gone down significantly, despite the fact that actually the profits of the company will continue to be relatively robust. Worth noting that there are now 3 activist shareholders who have taken significant stakes in the company in the last 6 months or so. One must never forget that the stock market is a discounting mechanism. So share prices, the stock market is always trying to anticipate 6 to 12 months ahead. And a lot of potential investors might look at the stocks in the Temple Bar portfolio and think to themselves, well, if we are going into recession, and we probably are going into recession, do I really want to hold some of the names that exist in the portfolio? And I've talked about some of those already. But don't forget the stock market is a discounting mechanism. If you can see that there's an economic downturn coming, so can everybody else. And it's probably already been priced in. And that's the view that we've taken in the trust. So as I say, we've used the fear that comes from expectations of an economic downturn to build positions, as I say, in fundamentally decent businesses which can prosper over the long term, and where we would expect to see a significant recovery in profits as and when economic conditions improve. So we actually think it's very important to distinguish between the economic outlook, which continues to be difficult, and the outlook for the investments in the trust, which we think, because of the starting valuations today, we think the outlook for investment returns is actually very attractive.